Good morning and good afternoon, everyone. Welcome to the very first Oxford Economics CRE Analyst joint webinar. We're very excited today to do this joint event and really open up some thinking that we've had in the industry on a couple of particular topics with some other industry experts. So we're really excited about today. I'll go do introductions in a second, but the agenda for today is to share a bit of our latest economic outlook, to talk about the new real estate sentiment index that we at Oxford Economics have created, but really make it a bit of a panel discussion and allow you guys to ask questions, probers, challenges on what we're thinking about, what we can achieve with the sentiment index, how can it be valuable to the industry, what more should we be thinking of, and how can we sort of continue to evolve the sector. Before we get into it all, however, we've got some really talented individuals on the call. I won't be able to do it justice by introducing them on my own, so I'll let them do it for themselves. But Richard, why don't you introduce yourself first, please?
Yeah, happy to do it, and super happy to be here today. George, we've been talking about doing this for a while, and it's fun to kind of finally launch this and to do it. I think it's a really interesting time to chat and also to talk about the sentiment index. I think that's really cool. We'll talk a little bit about what you guys are doing there. But super excited to see a lot of familiar names that are alumni of ours on this call, but also a bunch of people that we don't know or may not know who CRE Analyst is. So hope you guys learn more about us and connect with you in the future. But for a little bit of context, our goal at CRE Analyst was we saw this need that there were ambitious, hungry real estate professionals who really were looking for opportunities to keep developing their skills and sharpen their thinking. And so 6 years ago, we started teaching some courses. And in addition, we kind of started teaching courses, and then we started also posting what we thought is thought-provoking content online, and it built this kind of great network of people that are constantly bantering about where the real estate market is, where it might be going, what they're seeing day in and day out. And as we continue to kind of grow that, one of the things that we wanted to do was go find a couple of really strong thought partners in the industry that can accelerate and amplify that conversation. And when we started talking with you guys, George, I think that was a clear fit. We love y'all's approach in terms of trying to really cut through the noise of data and try to, as hard as it is, to really draw away insights. And I really value y'all's forward-thinking perspective, like the sentiment index, and trying to think about, hey, how can we amplify and improve the way that we take in data to make decisions in our business. So anyways, the only goal I'd say we have in putting this together from our perspective is I want everybody that's on here today that took time out of their day to walk away with like one new way of thinking about things. And well, I'm excited to hear everybody else's questions too. So I think you can put those in as we go through. We'll have plenty of time at the end for questions. But that's a little bit about me and about CRE Analyst, and appreciate you guys being a part of this and working with us on it.
Really appreciate it. Thanks, Richard. No, excited too. Ryan, would you mind just introducing yourself briefly for those who don't know who you are?
I'm Ryan Sweet. I'm the chief U.S. economist at Oxford Economics. I've been a professional economist for, I think, 20 years now.
Very good. Brilliant. Thank you. And Abby?
Yeah, so hi, everyone. I'm Abby Rosenbaum. I'm an associate director here at Oxford Economics. I'm based in the Boston area, and I'm in charge of our U.S. and Canada real estate forecasts.
Very good. And for those of you who don't know me, my name is George Armitage. I'm Global Head of Real Estate at Oxford Economics, and I'm based in London, but spend a lot of time in the US. We've already had a question about interest rates, but I'm going to hold the questions until the end, and then we can get into it. But someone's very keen, which is great to see. We were trying to sort of have a think about, how has the real estate sector gone this year? What is sentiment? And how are people feeling about the next 6 months? It's probably been one of the most uncertain volatile 6 months any of us have gone through, certainly since the GFC, for any of those who've got grey hair like me and can remember that. We thought it would be probably a good idea just to see whether the work we're doing on sentiment aligned it somewhat with what you're actually all thinking. So it would be really helpful if everyone could fill in this poll and just sort of give us your outlook for real estate for the rest of 25, compared to the first half of this year. Are we feeling more optimistic, mildly optimistic, pretty much the same, not sure, or much more pessimistic? Really interested to get your answers. So I'll leave that up there for 30 seconds or so, just to see where we stand before we get into things today.
George, you're going to have to tell them your answer for that once we give the results.
I will, yeah. But as true statisticians, we'll wait for the answer and then we'll find a solution that fits it. Okay, we're over halfway submitted. It's going pretty well, over 50%. So I think the other important thing to state, Richard, is there is a beer on the line here, because I have a view on how the audience was going to vote before this event, and Richard had a view on how the audience would vote, and we actually differed. So we're going to see who owes each other a beer.
Yeah, don't let me down, people.
Right. Okay. I'll give it another 10 seconds, and then I think we can have a go. Right, very good. Well, it doesn't seem like there's many more, so let's have a look. Richard, that is a tall pint of Guinness towards me, please. So I said the industry are eternal optimists, and no matter how bad it was, we would always be mildly optimistic when it came to a poll. It was self-serving, but it is good to see. Maybe that does go somewhat to people's optimism on where rates might go, or geopolitical risk might subside. Given what's going on right now, that could be a long order, but we will see. But yeah, good to see where everyone sits. But certainly, it feels like it's very much middle of the road, if not slightly more positive towards the end of the year. That's certainly feels what it says there. But I think what everyone expected is very optimistic is the minority. I think we all agreed on that one. Right, brilliant. Well, without further ado, it's probably a good idea to get onto Ryan. I think whether it's real estate sentiment or any other sector, everything is underpinned by the economy. So Ryan, take it away.
Thanks a lot, George. And I guess my goal is not to change the survey results after the next few slides. But I would describe myself as cautiously optimistic about the economy's near-term prospects. When I say near-term, next 12 to 18 months. But I think in our discussion, I kind of want to leave you with three takeaways. First, the U.S. economy has slowed, but it's not in a recession. Unfortunately, we're going to be vulnerable to anything else that goes wrong between today and early next year, because early next year, that's when the fiscal impulse from the fiscal package really starts to kick in. That's going to provide some cushioning to the economy. Point number two is that the near-term outlook is very sensitive to changes in tariffs. And unfortunately, the worst of the impact on the tariffs is still to come. So that's one of the key things to keep in mind, is that there's a lot of noise in a lot of the economic data that's creating a lot of volatility. There's a lot of uncertainty. But we do know that the inflation impact on you and I from these tariffs is coming, and it's going to hit this summer. So looking at July, August, we're going to start to see some of the noticeable impact on inflation. And that has implications for interest rates. And that's point number three, is that interest rates aren't coming down significantly this year. Our forecast is for the next rate cut by the Fed to occur in December. And the rationale behind that is that, the labor market, it's bending a little bit, but it's not breaking. So there's no urgency there for the Fed to start to cut interest rates. And the Fed wants to make sure they're reading the tea leaves of inflation correctly, and given the ebbs and flows in tariffs. And keep in mind the tariff rate is up significantly from where it was pre-inauguration. The Fed's going to be patient. They're going to sit on their hands, and they're going to want to wait this out as long as possible. So in fact, they're most likely going to err on the side of waiting too long before they cut interest rates. When it comes to long-term interest rates, we'll get into some of the concerns around debt, but the 10-year Treasury yield is going to remain above 4%, for the next 12, 18 months. So there's not going to be a lot of relief on the long end of the yield curve either. So I guess we'll dive right in, and what's usually top of mind is tariffs. And the tariff rate, as you can see in this chart here, it's pretty noisy, but I think it kind of highlights the ebbs and flows in the tariff rate. We factor in any changes in the effective tariff rate each time that we update our forecasts on a monthly basis. But you can see that there's been a lot of ebbs and flows, a lot of fluctuations and volatility in the effective tariff rate. But from my perspective, the key takeaway is that the effective tariff rate is up significantly from where it was pre-inauguration. So for context, before the inauguration, the effective tariff rate in the U.S. was 3-4%. Now we're up to 17%. And there is the risk that it goes higher from this point going forward. And in fact, from our perspective, the risks to the economy from tariffs are weighted more to the downside. There's very little upside risk to the economy coming from the effective tariff rate. But they kind of put this into context, a 17% effective tariff rate hits the economy. It's going to be inflationary. It's going to add a little bit less than a full percentage point to year-over-year inflation, probably sometime this summer, early fall. That hits discretionary spending because it reduces real disposable income. And no matter where you are up and down the income distribution, real disposable income, that's the key driving force of consumer spending. So this is essentially a demand shock for the U.S. economy. This chart can look a little bit scary, but we are away from the precipice of a recession, because the effective tariff rate, if it got up to 25, 26%, running the simulations through our global economic model, that is a recession. Now, of course, there are risks that we get back up to there because the 90-day pause on the reciprocal tariffs is coming to an end. But our working assumption, what's embedded in our baseline forecast, is that this universal 10% tariff is here to stay. Now we're going to see tariffs where they are in China. That's going to remain in perpetuity. The EU, tariffs aren't going to come down significantly there anytime soon. The two countries that we will see some decline in tariff rates next year are Canada and Mexico when the USMCA gets renegotiated sometime around mid next year. Maybe it happens a little bit sooner, but that's where we're going to see some relief on the tariff front. So all in all, tariffs are going to be here to stay. And the reason why is the most likely end game for tariffs is that it's a revenue raiser. And this is kind of highlighted in this chart here. You're seeing the amount of revenue that's going to be raised by tariffs. So, over the next roughly 10 years, tariffs will generate, at where they are currently, $2.5 trillion in revenue. Now, that's a big sum of money. It's a big chunk. But it doesn't make an enormous dent in the fiscal outlook, but it is a revenue raiser. And tariff revenue is essentially kind of, caffeine for lawmakers. Once they see that revenue coming in, they're not going to want to get rid of it. And that's why the tariff rates on a lot of our major trading partners aren't going to revert back to where they were pre-inauguration. And that doesn't matter, who wins in 2028, the outcome of the midterm elections, because what we saw with the Biden administration is that they didn't roll back these tariffs either, partly because of all the revenue that was being generated. The other thing to keep in mind is that the other potential end game is the idea of tariffs being used to reshore manufacturing, and we've done a lot of work on the feasibility of reshoring across different industries and different regions, and I'm very skeptical that tariffs are the key carrot to reshoring manufacturing. Now, of course, the Trump administration is using other carrots and sticks. For example, they may cut the corporate tax rate for manufacturers. They may create some incentives to build manufacturing structures in the U.S. But all in all, the idea of a massive amount of reshoring to the U.S., I think, is premature and overdone. And the other thing to keep in mind is that you can't have both. You can't have the tariff revenue and you can't reshore manufacturing. And I think given the U.S.'s fiscal situation and the feasibility of or the difficulty in reshoring manufacturing, tariffs ultimately are going to be used to raise revenue to help reduce, or slow the increase in the deficit. But keep in mind, we're on a very unsustainable path with regards to our fiscal sustainability. I mean, we've been on this path for decades now, but eventually the chickens come home to roost. And this is one reason why we've raised our equilibrium 10-year Treasury yield. So essentially where the 10-year Treasury yield will settle over time. And now it's closer to 4.2%. And one of the key reasons behind that is a higher term premium. And that's a function of a lot of things: macroeconomic volatility, some uncertainty, but also increased concerns about the U.S.'s fiscal health, not just today, but where we're headed down the next 10, 15 years. And the date that we have circled on our calendar is 2034. That's when Social Security on its current trajectory starts to really run dry. And the way things work in D.C., lawmakers need an incentive, or they need a fire lit under them to act. And that's going to be in 2034. That's when you're likely going to see the necessary first steps on the tax front, the spending front, to sort of get our fiscal house on a better trajectory. But where we're currently headed is unsustainable, and down the road, some painful decisions are going to be made. But all this is getting embedded in long-term interest rates. But for the near-term outlook, why we think the Fed's going to be patient and more reactionary than precautionary is that they're in the same boat that a lot of us are. There's a tremendous amount of uncertainty when it comes to inflation, how much tariffs are ultimately going to get passed on to the consumer. When we model it, roughly 2/3 of the effective tariff rate, increases in the effective tariff rate, get passed on to you and I. The other third is absorbed through corporate profit margins, foreign exchange effect, and then a substitution effect, of course. But the chart on the left-hand side is showing you that if you start to squint, you're seeing the impacts of these tariffs. So we decompose the consumer price index, the personal consumption expenditure deflator, by what parts are most vulnerable, or where we're going to see the biggest impact of tariffs, and you're starting to see those effects. You can look at, for example, case in point is the vehicle industry. We started to see wholesale prices at the end of April start to increase. That translates into higher prices at dealerships in May, June, and into July. So there are going to be some impact of these tariffs, and it's coming. The initial phase has been clearly disinflationary because oil prices came down quite a bit. The stock market had a very rough, several months there, and that lowers inflation via a reduction in portfolio management fees. So a lot of idiosyncratic, or I would describe it as noise, in the inflation data. But we do know that there is a lag between changes in tariffs and when it starts to show up in the prices that you and I are going to be paying. So the Fed's going to want to wait this out because they don't want to start cutting interest rates prematurely and then start to see the inflation data not cooperate and start to pick up, and they have to reverse course. The other reason why the Fed's going to be patient is the labor market. And there's plenty of fissures in the labor market, but no significant fault lines yet. And this gives the Fed time to be patient in deciding when to cut interest rates. And the chart on the right-hand side is showing you how we decompose the unemployment rate, because the causal relationship between a rising unemployment rate and a recession is layoffs. And so far, you're starting to see some increase in the number of people that are losing their jobs on a permanent basis. And temporary job losers is generally hanging in there at a pretty low level. This is something that we're keeping a very, very close eye on because, unfortunately, the hiring rate in the U.S. is well below average, but at the same time, we have very low layoffs. So it's a very interesting job market. It's a very bifurcated labor market. If you have a job, it's a great labor market. If you're unemployed, it's very, very difficult to find new work. It's not impossible, but it's taking a lot longer than what you would see over the last few years. So the duration of unemployment is rising. The number of people that are filing continuing claims for unemployment insurance benefits, that's climbing, and that kind of foreshadows further increases in permanent layoffs. But the weakness in the labor market, the fissures in the labor market aren't significant enough yet to cause the Fed to jump in and kind of ride in on the white horse and cut interest rates. But they're going to watch this closely. If the job market takes a sudden turn for the worse, and historically, the job market can turn on a dime, the Fed will have to pivot and cut interest rates if the job market starts to weaken. But so far, so good. The compression in corporate profits hasn't been significant enough to lead to layoffs. It's just businesses, given the uncertainty around tariffs, around fiscal policy and monetary policy, they're just waiting. They're sitting on their hands, and they're just not hiring workers at the clip that we saw over the last couple of years. Another thing on the inflation front and the uncertainty is oil prices. So given the escalation in the tensions in the Middle East, oil prices have moved higher over the last week or so. This is a different supply shock than tariffs, because historically increases in oil prices, they are inflationary, and that's what this chart here is showing you. This is just a simulation of our model. If we assume a $10 increase in the price of oil per barrel, and that's sustained, what's it do to inflation? And it's a temporary shock. That kind of works its way through over time. The Fed's going to be less responsive or worried about the inflationary pressures from oil than they would be from tariffs, because generally oil prices will revert back to their equilibrium over time, and that kind of puts some downward pressure on inflation. In fact, from my perspective, if oil prices were to rise significantly, that would actually bring forward the timing of when the Fed cuts interest rates, because it's going to do more damage to the real economy, because higher oil prices mean higher prices at the pump. That's less discretionary spending, and that's going to undermine the economy. Then they're going to be worried about the inflationary impact. The Fed's learned their lesson from the 1970s in the sense that big increases in oil prices kind of wash their way through the inflation data pretty quickly. They're not a permanent increase in the price level. So this is something to keep an eye on, because keep in mind, every penny at the gasoline station, so every penny increase reduces consumer spending by $1 to $1.5 billion over the course of a year. So the economic costs of rising energy prices can be quite substantial and be pretty quick to hit the economy. The other thing that we need to watch for when it comes to tariffs, geopolitical tensions in the Middle East, we do a lot of scenarios around potential outcomes, are supply chains. And we've seen a lot of front loading of consumer goods. So businesses, consumers, they've been acting rationally. And as economists, we always assume businesses and consumers act rationally, but in reality, more often than not, they don't. But when it comes to tariffs, they are. The consumer, you and I, when we hear tariffs, we think higher prices, so we're going to buy goods today rather than waiting for the prices to go up. And businesses also brought in a boatload of inventories. You can see that on the chart on the left-hand side in the first quarter. Businesses are continuing to bring in goods, given that we've had this 90-day pause. So any lull in the trade war, businesses are being optimistic in bringing in and importing as many goods as they can, because they don't know what the rules of the road are going to be next month, next year, 2 years from now. So they're stockpiling these inventories. And you don't see a significant drop-off in trade at some ports. So the chart on the right-hand side is just showing you the evolution of container volumes at the port of LA. And generally, it's in line with what we've seen over the last couple of years. But if you look elsewhere, so the port of Long Beach, for example, import volumes have dropped off quite significantly. We do know that imports are going to drop. The elasticity or price sensitivity of U.S. imports to fluctuations in tariffs is pretty high. It's almost 1. So we are going to see a noticeable decline in imports, just given the effective tariff rate's gone from 4%, 3-4% up to 17% in short order. So the hit to trade is coming, and trade, transportation, logistics, this is the epicenter. This is ground zero for the trade war. If we start to see any deterioration in the labor market, it's most likely going to show up here first. And I'm going to end on what worries me the most, and that's highlighted by these two charts here, and that's uncertainty. I spent a lot of my time as a professional economist studying the economics of uncertainty, and it's absolutely suffocating for the economy. The areas of the economy that are most sensitive to changes in uncertainty are business investment in equipment and software, research and development, but also structures. Businesses, if they're uncertain, if they have more questions than answers, they're not going to be investing in equipment or structures. They just sit on their hands. And when it comes to structures, non-residential structures investment, the ship has sailed for this year. The uncertainty has just been too high for too long. It's just been suffocating. And we're not going to see any noticeable improvement in structures investment outside of data centers until next year. And there's the potential that it's more of a U-shaped type recovery or prolonged U in structures, just given the uncertainty remains very high. And what these charts here are showing is different paths for uncertainty, what it means for business investment. There's a risk, and this is what keeps me up at night, that uncertainty just remains high. Trade policy uncertainty is come down a little bit, but at a moment's notice, tariffs can go back up, they can come back down, which is a lot of uncertainty there. There's less so, I'm not too concerned about the fiscal policy uncertainty. I'm worried about monetary policy uncertainty and what's going to happen to interest rates. We're going to get a new Fed chair next year. That's going to fan uncertainty in markets. So all in all, the only certainty in the outlook is uncertainty. And this is the thing, the risk to the forecast that really makes me nervous. Because when it comes to uncertainty, it doesn't just affect business investment to different varying degrees, but it also impacts the labor market. And if the hiring rate falls any further, we're going to start to see the number of people getting laid off rise. And keep in mind, that's the causal relationship between a rising unemployment rate and a recession. So I don't think I did a good job, George, of ending on a positive note to keep those poll results the same. But maybe I'll turn it over to Abby.
Yeah. Thanks, Ryan. Yeah, just before Abby goes in, I think, what it is what it is at the moment, right? But I think it's important for everyone to understand, how things are changing and how the outlook's evolving and the level of uncertainties we've got. I think it also feeds in nicely to, uncertainty in real estate is suffocating. You use the words, it's absolutely true. We've seen it in transaction activity in the last sort of several quarters. What we've also found in real estate is the data's slow moving. It takes a while to come out. It's delayed. We're often working with historic data, and that all feeds into the slow moving and liquid nature of the market. At Oxford, we're always trying to move things forward, whether it's moving it forward by updating the forecast monthly with the work Ryan's doing, or what we've just started working on, which is the new real estate sentiment index. And really the thinking behind this is how can we accelerate the feedback loop between what's going on in the market and what people are wanting to do. And to introduce a little bit of this and go through it, we have Abby.
Well, thanks, George, and thank you, Ryan. I'm going to try to to keep with the themes that have been set up thus far, sort of thinking about the poll and thinking about the upcoming slides. But I think just having that set up from both you, George, and from Ryan is going to be very beneficial for my next piece. So the commercial real estate has been in the midst of a pricing correction over the past few years. Following several rate cuts by the Fed in late 2024, capital values seemed set to rise this year. But due to uncertainty and the other pieces Ryan mentioned, we expect the pricing correction will persist in 2025. So when assessing the current state of commercial real estate performance, we factor in macroeconomic and real estate variables. But as George mentioned, backward-looking real estate metrics can make it challenging to assess these macroeconomic impacts as they're happening. So real-time, high-frequency data, such as the data we harnessed for our global commercial real estate sentiment indicators, can provide timely insights into current and future commercial real estate trends. Oxford Economics worked with Penta to develop a set of daily global commercial real estate sentiment indicators utilizing over 370,000 global data sources. This proprietary sentiment data is sourced from a broad universe of relevant outlets such as publications, news, print, media, and social media based on geography and the real estate sector. Custom search terms have been carefully developed and refined to capture a nuanced understanding of investment sentiment across global commercial real estate markets. Advanced natural language processing models are used to collect sentiment at a city and sectoral level across North America, Europe, and Asia Pacific. The models have been trained on over 14 years of data and have been fine-tuned by domain experts. In this slide, we're highlighting a few events to show the impact on sentiment. Notably, leading up to the tariff announcement, sentiment deteriorated significantly, and following a short rise in recent months as the tariff shifted, sentiment fell again in May. I wanted to highlight some of the topical applications of these sentiment indices at a city and sector level. Focusing on the recent trade tensions, are there noticeable shifts in hotel and the industrial sentiment? While there's been a noticeable deterioration, as I mentioned, in the overall commercial real estate sentiment, we discovered movements along sectors and cities were not necessarily uniform. For the industrial sector, as shown in the chart here on the right, relative movement in sentiment in certain cities worsened more noticeably than others. And this goes to some of the charts that Ryan showed about the port traffic. We're seeing some of that filter through to the sentiment indicators. So when we compare the 6-month moving average to the moving average since the tariff announcements in early April, the West Coast markets, LA and San Francisco, recorded a stronger drop than the East Coast markets, such as Boston and New York. For the hotel sector, which I'm showing on the left-hand chart, the downward adjustment in sentiment was more consistent. Cities such as New York, LA, and San Francisco, those markets dependent on international tourism, consistently saw a drop in sentiment in recent months. Our new Oxford Economics Penta commercial real estate sentiment indicators have multiple applications for commercial real estate. A few of those uses are they can support decision-making. So for example, weakening sentiment can help to pinpoint distressed assets for investment and contrarian investments. Number two, the indicators can enhance market tracking and forecasting. So shorter-term changes can be useful lead indicators for REIT returns, while long-run changes can help to explain transaction volume movement. Generally, we found that transaction volumes lag our sentiment by around 5 to 6 months. So we think Q2 will hold steady before a potential drop in Q3 this year. And finally, they can provide timely and forward-looking indicators. For example, they can offer high-frequency indicators for the demand side and supply-side fundamentals. So as we mentioned, we expect the pricing recovery will persist through the end of this year, with most sectors recording annual value declines. But the value declines will not be enough to offset income returns, and we project all property total returns will turn positive this year. All property total returns are expected to average about 6.5% per year over the next 5 years. Performance will be bifurcated among sectors, with hotel, residential, and retail expected to outperform their pre-pandemic annual pace. Retail's performance will likely be supported by grocery-anchored centers, with consumers focusing their spending on daily necessities as inflation is nudged higher in the near term. So as Ryan mentioned, the front-loading piece, potential supply chain disruptions, and softer consumer spending, we do expect will hamper industrial performance in the near term, and thus we don't expect industrial to surpass the double-digit average returns it saw during the e-commerce boom. And finally, for office, as it works through the work-from-home structural shift, it's expected to record the lowest average total returns over the next 5 years. So that's all from me. I will pass it back over to George.
Brilliant. Thank you, Abby. I really appreciate that. I mean, to try and simplify the sentiment index, everyone, real estate's always had the struggle of, we've always had to do surveys. It's always been slow moving. With any survey, there's always an element of bias, right, on who you're surveying. What we try to do is basically take a technology-driven approach to scan a huge amount of data to build up a view on what's going on in sentiment, and then do it on a daily basis. So as good as you can get, try and do it in real time, which is a challenge everyone struggles with, whether it be private markets, public markets. Do we have it all perfect? There's obviously more we can do, but I think what we've got is something that we believe that could be, changing in the industry. And I'm really interested to hear your thoughts. So please put your thoughts in the questions, or any questions you do have, or email us. But I'm also really interested to hear the thoughts of sort of Richard and the guys from CREA Analysts. So, Richard, I'm really interested to hear what you think of a sentiment index, doing it data-driven, doing it in real time, and some of the applications you think could work for the industry that you've got so much experience in.
Yeah, I mean, I think it's one of the reasons when I first saw this come out, I was really interested in it is because one of the fundamental beliefs that I think a number of us on our teaching team and our team share, that one thing that is a little different about this real estate cycle that we're heading into is this kind of disaggregation of performance, that we don't have this huge tailwind of decreasing rates to kind of make everybody look great. And I think you see this really clearly in office. I think it's probably going to occur and is occurring to some extent in other asset classes, but you have this kind of bifurcation of performance, right? Abby's chart had office. I think in the past, it's been a little bit easier to look at that and say, well, on average, office is going to perform at X. But I think going forward, it's going to be really hard. You're going to get different performance based on asset classes, submarkets. And so one of the things I find really interesting beyond the kind of real-time nature of the feedback of this is the ability to start to read sentiment and at both an asset class specific and geographic specific level. Because I think as performance does disaggregate, whether you're managing a portfolio that you're trying to kind of continually trim and modify so that you can continually outperform, or you own a singular asset and you're trying to decide, hey, when's the right time to go sell it. It's just another data point that's a little more fresh. I don't think it, is going to be something that that people are going to look exclusively to one measure and another, but it is a really valuable one that is a quantifiable one. Rather than just talking about market sentiment, we can actually put a number on it. And I guess the last thing I'd say is sentiments are really impactful. I mean, in Ryan's larger macroeconomic world, sentiment's huge. It really drives where spending's going. So that to the extent that we can measure that in real estate, I think it's going to help us get a little better feel for where things are and maybe be able to predict a little bit better about where we think things might go.
Yeah, no, it's really interesting. I mean, we've had a couple of questions about the sentiment index. I mean, I think it's probably worth saying that, this can be updated on a daily basis. This is real-time data that we're taking, and to give some understanding about how we put this together. So we're using a company called Penta that pulls together data that looks at different topics, looks at different countries. And what they're looking at is publicly available articles, newspapers, private. They're looking at industry reports. They're looking at briefings. And they're looking for keywords, key topics. They're looking for positive and negative sentiment towards that. So it could be a particular company brand. Something's happened in the news. It could be a positive and negative sentiment around that, right? But you also get that in real estate, and then you get, big company moves to Dallas, jobs created, right? Positive sentiment. But you can do this, you can start to break this down by country, by sector. You can look at, say, just employment-focused sentiment. You can look at real estate investment. You can look at REIT. So you don't actually need, you can look at a global real estate sentiment index as an aggregation. But if you want to do something specific, you can also do that. You just need to talk to us. I mean, we had an interesting client come to us and say, look, we really think we want to do, a strip mall, sort of start raising for a strip mall fund. What is sentiment from investors towards this? And we're able to say, well, actually, we can target that. We can target, what is sentiment towards spending, towards this level of income band. So you can start to sort of really narrow it down, and that's some of the application. But someone wrote a question about the frequency. In response, the idea is we can do this daily. It's a very powerful tool. Obviously, you need to take it with a pinch of salt when it comes daily, because you need to see through the noise like any data. But that hopefully answers that question. I think it's probably worth asking Ryan about sentiment. Ryan, you've been working with this data a lot more from a macroeconomic point of view. How have you found the relationship between the data we've been using with Penta and our macro forecasting?
I think I just reiterate the points that you made earlier, that it gives you a real-time look at what's going on. In an environment like we have today, we turn to a lot of high-frequency economic data. So, of course, it's not just on CRE, but also elsewhere in the economy, because things are changing on a day-to-day, week-to-week basis. And a lot of the economic data that we traditionally look at is already backward looking because things have changed and evolved so quickly. So we look at the sentiment data in this that we created with Penta to kind of gauge, is our baseline forecast for non-residential structures, is that too optimistic, too pessimistic? Is the baseline still, what are the risks around the baseline? But looking at things on a daily basis, we do it with not just CRE, but every part of the economy. We look at consumer spending, looking at dining out on a daily basis. We look at the number of people going to Broadway shows, sporting, number of people going to sporting events. So, the high frequency data, as a macroeconomist, the thing I would leave you with is that, when you're forecasting a $30 trillion economy, it's like reading a map. You don't know where you are, and you don't know where you're going unless you know where you are. And that's where this high frequency daily data, including the sentiment indices, are very helpful in assessing where you are today. And that helps shape your view of where we're headed.
Yeah, well, thank you, Ryan. We interestingly, we had a question in text, and what we'll do is all the questions that have come in, and there have been a lot, if we don't get time to answer them in the next sort of 3-4 minutes, what we'll do is we'll get back to you individually and answer your questions. We've had questions on wage pressures, interest rates, 10-year rates, Fed easing, the benefits, and should we do more tariffs? That was an interesting one. So we'll get back to all the questions individually. I mean, I think, an interesting one, really perhaps for Abby, is, you showed a slide about sentiment by asset class or market. I mean, when you were doing the work, what surprised you in the data, when we're looking into this?
Yeah, so, I think that really, some of the things that jumped out to me was sort of the impact from the industrial side, just looking at the tariff impact, the harsher impact on San Francisco versus LA, and it again, sort of, you can't look at these pieces just individually, that there is sort of a collective view here. And so hearing from Ryan and thinking about the port data, because that is high frequency, timely data as well, and sort of marrying those two stories that we haven't really seen that deterioration in the LA port data yet. Long Beach, we have. And so perhaps that there is this sort of, there's this adjustment that investors are making because they aren't seeing necessarily all of the data point to, weakness in LA. Another one that really jumped out to me was sort of the relative outperformance of New York. So much during the pandemic, there was a lot of talk about, the sort of the weaker gateway cities and how long that's going to persist. And for, New York to now be at the top, I think is a very fascinating story, and one that, that I certainly agree with. So, there's been a lot to sort of pull out. I could go on, but I know we have a time constraint.
No, I mean, it's probably worth inviting Richard just to do some final comments. I'm aware we said we'd try and do this in 45 minutes to get you guys back to your busy jobs. But Richard, I don't know if there's anything else you want to add in terms of...
I will, if you'll give me the liberty to do it. I want to ask Abby one question, and it'll be challenging to answer it quickly, but I want to layer a couple of things that people put in here. And one of the questions is, I'm going to layer two parts into it, are cap rates tied more to interest rates or capital flows, essentially? And then pairing into that, like, there is a real, one thing that these tariffs are driving, and just the general environment, seems to be a lowered appetite from international capital to come into the US market, at least in the short term. So, like, how do those things, whether it's interest rates and capital flows, impact where kind of values go? And any thoughts on which of those is going to have a heavier influence over the next, call it several months, or call it 18 months?
Sure. No, happy to answer that as quickly as possible. I think it's a really interesting question, particularly given the fact that over the past few years, it was really a capital markets correction. And now we're sort of in this period of maybe the change in fundamentals and how fundamentals are performing, that may be impacting things more in the near term. But certainly from our work, the 10-year has been something that has been directly tied to our NOI yield forecasts. And we did adjust specifically our industrial yield forecast up this most recent quarter over the next year or so, just because of those spreads for industrial and for apartment, they've been negative recently. So, from our work for NOI yields, it's really tied to the 10-year. And so, as Ryan mentioned, we do expect it to remain elevated, and that's going to keep yields higher. And I think that the combination of sort of softer rent growth in the near term is going to keep values, in negative territory, not as negative as last year, but in negative territory this year.
And foreign capital, do you think it slows down coming into the U.S. market?
Sure. I'm cautious about stating anything without looking at the data, and looking at sort of the cross-border activity, but that is certainly something that I will be keeping my eye on, particularly, as we go through the year. We'll just sort of keep track of it as of right now. But, I do expect that, we will start to see some trends in the near term in terms of, overseas investment into the U.S.
What I can say on that, Richard, just I know we've sort of just gone over by 2 minutes, but just from our sort of global client base, both on the asset management side, multi-asset and real estate, is there's certainly been an interest from the country north of your border, outside of its domestic market, into the UK and Europe and Asia, less so to the south of its border. I'm talking about Canada. But I was in Asia in February, and a lot of the money wanted to keep going to the US. There was no change, and it was the same, if not more, for those big key core investors. But a lot more interest in places like Australia. We've also seen quite a bit an increase in PE capital chasing returns in Europe, as well as the spreads and the relative returns start to outperform bonds. But we're very happy to answer any more questions. There's been a load of questions that we will try and get back to. Some of them actually can be answered in the research briefings we've written on the sentiment index that are available to download off this platform. They're just at the bottom, or they should be. Any questions, obviously, we can send those round. We will send the slides to everyone who attended, and we will publish the poll as well. But I just wanted to say, really big thank you from me on behalf of Oxford Economics to our speakers, and also to Richard. Thank you very much for helping set this up with us. I really hope it's been valuable to the audience. So thank you to everyone. We really hope it was a good use of your time, and we wish you a good rest of the day.
Yeah, thank y'all for joining, and we hope to do more in the future. If y'all found it valuable, let us know. We don't, hopefully it was a good 49 minutes of your time, and really appreciate y'all spending it with us. Thank y'all.
Thank you.